What does it mean to invest in something? That's what we'll look at in this chapter. Investment is an act of putting money to use by purchase of or expenditure on something offering profitable returns. The essential characteristic of an investment is that some or all of it is at risk or is unavailable until sometime in the future. The decision to invest is a decision concerning the potential loss of value associated with changes that might take place between the time of the investment and the time when the money can be recovered. An example of savings, if you're putting money into a savings account, that is not an investment. That is savings. There is absolutely no risk unless by some slim chance the bank goes down, but then there's insurance for that. So that's an example of something that we might think of it as an investment, but it is truly not an investment. Real options are those that are related to capital assets rather than financial assets. So in traditional cash flow analysis, it's assumed that the project will proceed in accordance with expectations. The difference comes only for circumstances that are different from the assumptions used in the discounted cash flow analysis, circumstances that require other options to be considered. So in the following slides, we'll review these real options. So management holds a lease on or an option to buy valuable land or resources. It can wait however many number of years to see if output prices justify constructing a building or a plant or developing a field. So for example, go back to week 1 and the exercise we did on the School Creek mine. Peabody acquired the reserves in 2006, planned to open the mine in 2008, delayed it to 2009. The economy tanked slowing demand for coal, so they slowed down plans for opening it even further into the future. So Peabody exercised the option to defer. Staging investment as a series of outlays creates the option to abandon the enterprise in midstream if new information is unfavorable. Each stage can be viewed as an option on the value of subsequent stages and valued as a compound option. This is a time to build option. On page 32 in the text, it discusses a problem that looks at payback of a project and whether to start with one larger capital investment or start small and invest incrementally. The example is in construction planning, where we design a building for 30,000 square feet, but we only build the first part that is 10,000 square feet. But the building is modular in nature and can be added to as demand increases. We decided to build in increments rather than have a large capital investment for a building that may go underutilized. So that's an example of a time to build option. If market conditions are more favorable than expected, the firm can expand the scale of production or accelerate resource utilization. Conversely, if conditions are less favorable than expected, it can reduce the scale of operations. In extreme cases, production may be halted and restarted. So this is an example of an option to alter the operating scale. The text uses the example of using contractors on your mine sites to ramp up work when conditions warrant, and then you can let them go if you decide to cut back. If market conditions decline severely, management can abandon current operations permanently and realize the resale value of capital equipment and other assets through secondhand markets. Consider an expenditure of $50 million on a shaft to access an unknown ore body. This investment is worth nothing if the ore body proves to be grossly under expectations. Conversely, $50 million spent on a truck and loader fleet in the same circumstance may still be worth $40 million on the secondhand market. So the amount of funds at risk is vastly different even though the total capital is the same. In this case, the option to abandon the project is being considered. The option to change, switch inputs or outputs, occurs if prices or demand change. Management can then change the output mix of the facility, product flexibility. Alternatively, the same outputs can be produced using different types of inputs. That's process flexibility. This option is particularly relevant in multi-product mines where different ore bodies have different proportions of metals, or where coal can be washed to different specifications. Similar to the time to build option, growth options recognize that certain actions, for instance R&D, can be narrowly focused on the project at hand or more broadly focused. Mining companies that learn the subtleties of treating certain ore types can retain and capitalize on this knowledge, leveraging it to gain advantage positions in the ownership of other ore bodies with similar characteristics. Real-life projects often involve a collection of various options. This category is a recognition that combinations of options, in other words, one that offers protection against losses and one that offers revenue enhancement, can have value exceeding the sum of the separate parts. The ability or the inability of a project to adapt to changes establishes the real risk of a project. For example, what if the price of fuel changes as well as the cost of labor? When this happens, there will be changes in prices of mine outputs. When this happens, resources would be redirected into producing more of the products for which the selling prices had increased and less of the products where prices have decreased. If fuel oil prices rose substantially, equipment that operated on electricity would be more heavily used, and equipment more dependent on fuel oil would be changed out and replaced by the electrically powered equivalent machine. So you need to evaluate the market value of a project if there was an ability to change, and also when there is no option to change. Typically, more capital-intensive alternatives are also less flexible, with a higher proportion of capital at risk in the worst-case scenario. So worst-case scenarios are always prepared for major projects, but they can be hard to anticipate. When you have unpredicted poor performance and you need more financing, the incremental cost for this additional capital investment may be very high. Lenders do not like providing even more financing to projects that have yet to prove they can perform. So in simple terms, when you, as the owner of a non-performing mine, go back to the bank and ask for more money, you have no leverage at the bargaining table. So instead, you can negotiate an option to acquire additional funds at the beginning of the project at little cost. There may be slightly higher interest rate on these funds if they have to be called upon, but this higher rate is small compared to the cost of not having the funds available. The rationale is that the firm knows that particular parts of the plan will prove inadequate. They just don't know which parts. It is more economical to under-design initially and then institute remedial work than risk over-design in areas that will prove unnecessary.